The US Treasury's recent rally is on hold as traders anxiously await key consumer price data that will heavily influence the Federal Reserve's upcoming policy decisions. Let's get straight to the point. Why does this data matter so much? Because it's not just about understanding where interest rates might go, it's about recognizing a potential shift in the narrative from the Fed. Over the past 2 days, we saw a significant boost in the US Treasuries market. This rally came as a response to 2 primary factors. First, there were some surprisingly strong producer price data that signaled a potential peak in inflation. Second, comments made by Richmond Fed President and his speech in which he expressed concerns about the banking sector and the overall economy. In simple terms, these factors created a situation where investors started to believe that the Fed might not raise interest rates further. That's why we saw the bond market rally. However, the question now is what happens next? And the answer lies in Friday's consumer price data. Here's what you need to know. If the data shows that inflation has indeed peaked and is moving downwards, then the market sentiment could shift. The possibility of the Fed keeping interest rates unchanged in September could become a real consideration. This could be a game changer because it would essentially mean that the current rate hike cycle is over. And if that happens, bond prices are likely to soar. But here's the catch. If the CPI data does not show a clear downward trend, then the sell-off in bonds could resume. The market could push back against the notion of a September rate hike, leading to higher yields on treasuries. So what's the current expectation? Well, the market is almost split in half. There's a 50% chance that the CPI will come in cooler than expected, which could bolster the case for a pause in rate hikes. At the same time, there's a 50% chance that the CPI will meet or exceed expectations, which could lead to more rate hikes. Now, here's an additional twist. Even if the CPI data is strong enough to support another rate hike, the market might still push back. Why? Because of the recent banking sector turmoil. If the market believes that the economy is weakening, then a September rate hike could be seen as a negative for financial stocks. This could create a situation where the market starts pricing in a higher probability of a rate cut in October. In conclusion, today's CPI data is crucial for the future trajectory of interest rates and the overall economy. While the initial reaction to the data will likely be extreme, it's important to remember that the Fed will take a wait-and-see approach before making any decisions. Regardless of what happens next, one thing is clear. The coming weeks will be filled with uncertainty and volatility, making it difficult for both traders and investors. If you found this video helpful, please give it a thumbs up, and don't forget to subscribe for more updates. See you in the next video.